Imagine a company completely bombing its quarterly revenue expectations. I'm talking a massive miss. And yet, the stock actually shoots up nearly 10% on the exact same day. Well, on August 4th, 2026, that is exactly what happened with Beam Therapeutics. They released an earnings report that, by all traditional financial logic, should have completely cratered the stock. We're talking about a massive, glaring disconnect between short-term financial performance and the market's reaction, and that is exactly what we are going to unpack in this explainer.
Let's look at the brutal reality of that second quarter miss. Wall Street analysts were expecting Beam to pull in around $16.37 million in revenue. What did they actually report? $490,000? Yeah, $0.49 million. And to make matters worse, their net loss widened to a staggering $122.7 million for the quarter.
Now, normally, you'd expect the bottom to just fall out of the stock, right? But here is where the story completely flips. Instead of plummeting on this massive revenue shortfall, Beam's shares actually surged. They jumped over 9% that very same day, closing at $28.35. So, why on earth is Wall Street completely ignoring this short-term financial bleeding? Well, the answer is the central mystery we are going to solve today. Institutional investors, they are looking right past this quarterly revenue volatility because they are intensely focused on a massive underlying scientific moat. To really understand what the big money sees here, we've got to understand the engine driving this business. Beam Therapeutics is a clinical stage biotechnology company. That means they don't actually have commercial products to sell you and me just yet. Right now, their near-term cash comes from licensing fees and milestone payments from heavyweights like Eli Lilly. Literally, their entire value is staked on pioneering a highly precise next-generation class of genetic medicine. And the way they do this is actually brilliant. Think of conventional CRISPR-Cas9 as a pair of molecular scissors. It creates these double-strand DNA breaks to disrupt genes. It works, sure, but it leaves the cell to kind of clumsily stitch itself back together, which can cause random mutations and chromosomal rearrangements. Beam's base editing platform, on the other hand, operates more like a molecular pencil. It chemically converts just a single target nucleobase into another, without cutting the double helix at all. It is incredibly precise, highly predictable, and for clinical sites, that predictability is literally everything. But it's not just cool science, it's a fortress of a business model. They have built a massive structural moat around that molecular pencil. First off, they hold the exclusive worldwide intellectual property rights to these foundational base editors. Second, they create intense ecosystem lock-in. Once a hospital spends the capital and trains their specialized teams to onboard Beam's complex cell therapy protocols, the switching cost to move to a competitor is just astronomical. And third, unlike a lot of their peers who rely on outsourced manufacturers, Beam actually operates their own fully commissioned 100,000 square foot clinical-grade manufacturing facility right in North Carolina. They completely control their own destiny. And they built that massive infrastructure to serve some truly giant addressable markets. Their lead candidates target huge economic potentials. Risto-cel targets severe sickle cell disease, a subsegment representing an immediate $20 to $30 billion market. Meanwhile, their in vivo candidate, Beam 302, targets alpha-1 antitrypsin deficiency, or AATD. That global therapy market is projected to reach almost $10 billion by 2033. So when you see the market completely ignoring a single quarter's revenue miss, this right here is exactly what they are valuing instead. But look, we can't just ignore the bear case because the central conflict here is very real. Beam is pre-commercial. That means they are burning through cash rapidly. Plus, they're playing catch-up. Over in the hematology space, they're going head-to-head with giants like Vertex and CRISPR Therapeutics, who already have an approved therapy out there called Casgevy. That drug already recorded $116 million in sales in 2025 alone. So Beam has to prove their molecular pencil isn't just different, but so vastly superior that it can steal market share from an entrenched, first-mover competitor. So the million-dollar question, or really the billion-dollar question, is can they survive long enough to actually win that fight? Well, the hard financial evidence from that August 4th earnings report says yes. As of June 30th, 2026, Beam was sitting on $1.15 billion in cash, cash equivalents, and marketable securities. Management projects that this massive capital reserve, along with their strategic credit facility, gives them a rock-solid runway to fund operations all the way into mid-2029.
And that cash runway is absolutely crucial because it bridges them directly to some major thesis-defining catalysts in late 2026. Right now, investors are laser-focused on a September 2026 data presentation at the European Respiratory Society for Beam 302, and the massive milestone of submitting a biologics license application for risto-cel by the end of the year. This is the exact reason why, even after slashing their 2026 revenue forecasts, Wall Street analysts largely stuck to their guns and kept their price targets up above $51. And hey, just really quick, if this kind of deep, research-first analysis is your thing, you'll probably want to make sure you're subscribed. We love digging past the headlines to find the real story. Okay, let's synthesize all of this into a qualitative scorecard to see the overall business quality. The fundamentals here actually reveal a pretty divided picture. On one hand, financial health scores a solid 8 out of 10, entirely thanks to that billion-dollar runway we just talked about. And growth outlook, that's a 9 out of 10 because of just how programmable that base editing platform is. However, profitability is a dismal 2 out of 10, and management alignment sits at a 6 out of 10. Why? Well, even though CEO John Evans holds a large stake, the broader executive team registered net sales of about $10.5 million over a recent 90-day window. That kind of persistent insider selling definitely creates a technical overhang. So, when you roll all that together, it results in a blended business quality score of 6.7 out of 10. The high conviction in their pipeline and those massive cash reserves are undeniable, but that score is ultimately being constrained by their complete lack of a commercial track record and current unprofitability. Now, all of the research behind this explainer was actually created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, those under-the-radar names with asymmetric upside; and dividend hunters, providing durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Just scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's project this forward. But before we get into the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's break down these 5-year scenarios heading into 2031, starting from a base price of $26.51. In our high case, driven by flawless execution and approvals for both risto-cel and Beam 302, Beam hits $1.4 billion in revenue. If we apply an 8 times multiple to that, we get an implied share price of $97.39. Our base case assumes more standard commercial challenges and slightly slower uptake, reaching $850 million in revenue, which puts the share price at $42.50. But we have to look at the low case, and it is severe. If their trials stall out and continuous cash burn forces heavy equity dilution, revenue might barely hit $300 million, dragging that share price all the way down to $6.92. Now, when we actually assign probabilities to these operational outcomes, say a 30% chance to the high, 50% to the base, and 20% to the low, we arrive at an expected probability-weighted target of $51.85. And guys, this explicitly resolves our core mystery. This right here is exactly why the market bought that Q2 earnings dip. The mathematically derived long-term upside dramatically outweighs one quarter's missed collaboration revenue. But to actually achieve that upside, Beam has to navigate some seriously intense, thesis-breaking risks. First is company-specific execution. If their clinical-grade ex vivo manufacturing fails to scale up efficiently, risto-cel's whole best-in-class profile basically dies on the vine. Second are the competitive risks. Rivals like Wave Life Sciences are aggressively pushing RNA editing therapies for AATD. If they enroll their trials faster, they could literally steal Beam's market out from under them. And finally, regulatory risks. The FDA could easily slap a clinical hold on Beam's lipid nanoparticle platform if they see things like transient liver enzyme elevations. Any of these scenarios could rapidly exhaust their cash runway. So what does this all mean? Here are the 3 most vital takeaways you need to remember. Number 1,
Beam's molecular pencil-based editing platform provides a highly predictable, highly defensible structural moat. Number 2, their massive $1.15 billion cash cushion ensures they can actually survive this pre-commercial cash burn all the way into 2029. And number 3, it's those upcoming late 2026 regulatory and clinical catalysts that are the true drivers of the stock. They completely overshadow a single quarter's revenue miss.
Going forward, the single most important thing to watch is the execution of their Beam 302 global pivotal cohort. That is the ultimate test of their in vivo liver targeting platform and their path to accelerated approval. It leaves us with one massive question. Are we witnessing the early days of a generational biotech giant, or will the cash run dry before the science is fully proven? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.